Nvidia has been one of the most impressive growth stories in the market in recent history. In just the last 5 years, the stock has risen over 1,800%, taking Nvidia's market cap from around $150 billion in March 2020 to a bit under $3 trillion today, with Nvidia at one stage in the last 12 months temporarily becoming the largest company in the S&P 500, overtaking Microsoft and Apple. That's an impressive compound annual growth rate of around 80% each year, meaning over the last 5 years, the stock has almost doubled in price every year. Put another way, if you had invested $50,000 in Nvidia 5 years ago, you'd be a millionaire today. That's unbelievable performance from a large listed company, the kind of performance that you might see in a small company that is scaling really quickly or in a market bubble. Now, what I want to do in this video is take a deeper look into Nvidia, see what's going on with some of the fundamentals and what is driving the stock price in the past few years. I'm also going to do a deep dive into Nvidia's future growth prospects and see what is driving the potential future demand for their chips over the next few years, so stay tuned for that. I think you'll find it very interesting. Then once I've completed these assessments, I can make a more informed decision on Nvidia's current valuation. A bit of background for those that don't know, Nvidia is currently the third largest company in the S&P 500 and specializes in high-performance graphics processing units, better known as GPUs. Initially, GPUs were primarily used for computer graphics, and the demand for these chips was primarily in gaming. Now, what's interesting is that these GPUs are really good at performing massive numbers of calculations simultaneously, which also makes them well suited for computationally demanding tasks like AI, machine learning, and cryptocurrency mining. And increased demand for this processing has factored into the growth in the company over the last decade. So that's a quick intro on the company. Now let's look at the figures behind Nvidia. To analyze the fundamentals of Nvidia, I'll be using my investment analysis platform. As always, the link is in the description if you want to try it out for free and follow along. So here we can see the price increasing, and what we can see is that most of this increase in price has occurred between the beginning of 2023 and the end of 2024. So mostly over the 2 years. Normally with the price, I want to compare it to the underlying free cash flow and sometimes earnings. Now, what we can see is that the price to free cash flow is sitting at around 47 times, and the price to earnings ratio is sitting at around 40 times. That's a bit higher than the overall market, which is trading at around 30 times earnings. So Nvidia is trading at a bit of a premium to the market. Interestingly, I can see that Nvidia's price ratios are actually at the lower end of their historic ranges. So Nvidia looks like it is relatively cheaper than it was in the past. I think part of this is that the price has been trading relatively flat over the last 9 months, whilst earnings and free cash flow have continued to grow. Now, we can compare Nvidia to a company like Meta and see that Nvidia is trading at price ratios that are higher than Meta's ratios, which are sitting between 20 and 30 times. We can also compare Nvidia to a company like Apple and see that Nvidia is trading at price ratios that are actually fairly in line with Apple's ratios, which are sitting around 40 times. So that's comparing Nvidia to two other Magnificent Seven companies, but what about the other companies in the semiconductor industry? We can compare Nvidia to a company like AMD and see that Nvidia is trading at price ratios that are actually lower than AMD's ratios, which are sitting above 80 times. So Nvidia is relatively cheaper in this case. We can also compare Nvidia to a company like TSMC and see that Nvidia is trading at price ratios that are a bit higher than TSMC's ratios, which are sitting between 28 and 37 times. And finally, we can compare Nvidia to a company like ASML and see that Nvidia is trading at price ratios that are a bit higher than ASML's ratios, which are sitting between 28 and 34 times. Now, this is just a high-level comparison and obviously doesn't take into account every nuance that might be driving these ratios, such as the growth expectations for each company. But what I think we can start to see is that Nvidia doesn't appear to be trading at a wild valuation compared to some of its peers, the market, or its historic rates, though it is trading at a relative premium of 1.5 to 2 times more than the market or its peers. But this could be because of high growth expectations built into Nvidia's stock price. So what we'll do next is have a look at the historic figures and growth drivers, and that should help us better understand Nvidia's business model and the demand for their products. Once we have some insight into that, we can assess the drivers of future demand. Before we do that, I'll just point out that the rest of Nvidia's fundamentals are looking really good. We can see a meteoric rise in revenue, earnings, and free cash flow, and also at a per share level. Earnings and free cash flow have kept up with the price increase, and this has kept Nvidia's price ratios below their historic rates. Returns on capital have historically been around the 20% plus range. These naturally increased with the increase in earnings, and Nvidia has been growing their margins, so overall the company looks strong fundamentally. Now, diving into their revenue split in 2025, we can see their revenue is broken into computer networking, which is mainly your AI data centers, and graphics revenue, which is GPUs that are typically used for gaming. In January 2025, computer networking was $116 billion, making up around 90% of Nvidia's revenue, so a substantial portion of Nvidia's revenue. Looking back to 2021, the segment only brought in around $7 billion and made up 40% of Nvidia's revenue. To get from $7 billion to $116 billion in just 4 years is nothing short of impressive and shows just how much demand there has been for AI data centers and Nvidia's chips. This is effectively a compound annual growth rate of 100%, so this revenue stream has effectively been doubling every year and is what has been driving the meteoric rise in the stock. We can see here that computer networking is also bringing in most of the operating income. So with computer networking comprising a significant majority of the revenue and income, I'll be focusing on this to see whether these levels of revenue are at least sustainable. Included in the segment, revenue from data center computing grew 162%, driven primarily by the demand for their Hopper computing platform, like the H100 chips, used for large language models, recommendation engines, and generative AI applications. These chips can cost upwards of $30,000 to $40,000 per unit and can cost up to $400,000 for a GPU system with multiple H100 chips in it, so expensive pieces of hardware. We can also see that 3 of their customers make up more than 30% of their total revenue. That's $40 billion, and each spent around $12 to $14 billion on chips. So there is a bit of concentration risk here, where a large portion of NVIDIA's revenue is coming from a small number of clients. So what we want to see is how dependent these customers are on NVIDIA, and whether NVIDIA can further diversify their service offerings across a wider range of clients, because if these clients scale back demand, it could negatively impact NVIDIA's revenue growth and stock price. These customers are likely the large cloud service providers and mega cap tech stocks like Meta, Google, Amazon, and Microsoft, given the scale of the expenditure and from what we can see in historic reporting and stats. We can see here that Microsoft purchased around 485,000 Hopper AI processors in 2024, Meta purchased around 224,000, Amazon bought 196,000, and Google bought 169,000 processors. So that's over 1 million processors between these 4 companies alone. Looking at the capex spend of each of these companies, Microsoft spent $55 billion in 2024, Amazon spent around $75 billion, Google spent over $50 billion, and Meta spent around $40 billion. In total, that's around $220 billion in 2024 alone. Now, this is not just chip expenditure, but it does give us a benchmark to compare against the forecasts we're seeing from these companies. So let's have a look at some of the demand for next year and beyond to see how sustainable NVIDIA's growth is. Now for demand, we'll look at a few factors. We'll look at some planned expenditure and commentary from key existing customers. We'll look at the demand for AI services. We'll consider the impact of DeepSeek on demand for NVIDIA chips. We'll also consider the need to replace existing data center GPUs, and we'll consider the impact of potential competition for NVIDIA. Starting off with the key existing customers, when we look at major tech players, we can see that Meta, Google, Amazon, and Microsoft plan on spending around $280 billion on AI data centers in 2025, roughly a 30% increase on the $220 billion of capital expenditure we saw from these companies in 2024. Adding further momentum, the recently announced Project Stargate aims to channel up to $500 billion into US AI data center infrastructure by 2029. AI chips make up a large portion of data center spend, so I expect a large share of this capital will likely go towards chips. Now let's break down what some of the industry leaders are saying. We'll start off with Andy Jassy, the CEO of Amazon, which is currently the world's largest cloud service provider. In a recent interview, Andy highlighted that the demand for AI services is currently outpacing supply, with one of the major bottlenecks being the availability of chips. He predicts that the demand for chips will outpace supply for the foreseeable future, an encouraging sign for companies like Nvidia.
And you've actually just took to the stage yesterday to say, out of all companies, you are spending the most on AI. How much are you spending on AI?
Well, I think we don't disclose the exact amount, but we're spending a pretty significant amount of capex, and the lion's share of it is on generative AI. We've said in our AWS business, even though generative AI for us is a many billion-dollar a year business and growing triple-digit percentages year over year, that if we had even more capacity, we could use it and monetize it.
Talk to us about that capacity that you talked about.
Yeah.
AWS could grow even faster if you had all the chips that you needed, all the power you needed, the motherboards you needed. How much faster could AWS grow?
It's hard to put an exact percentage, but I do think it could be growing faster. I mean, I'm confident it could be growing faster. And there is for a long time there still aren't as many chips as we all want. We're fortunate in that we're very big partners with Nvidia, but then we also have our own custom AI silicon in Trainium 2, which we just released at reInvent, which is 30 to 40% more price performant than the GPU powered instances, which is a big deal at scale if you're doing generative AI on the inference side. So we have maybe more chips than some others might have access to, but we still don't have enough. And then there just is not enough power in the world right now. And we're all working really hard on that. I expect that to relieve some the second half of this year. But right now, and the world can change, but right now we have just insatiable demand.
We heard amazing demand coming from Jensen Huang, who had his numbers out yesterday in Nvidia. Was there a limitation on the Nvidia chips in particular that pulled back capacity? And at what point do you think you can depend even more on your own in-house built chips to offset any of that?
Well, I would say I mean, there's a lot of demand for generative AI right now. People are very excited about it. I think that all the different providers of chips have been constrained to some extent. I think some of the new generations maybe have gone through different evolutions and when they're going to be released, maybe a little later than people thought. There are some components like motherboards and things like that we all use that particular ones are in shorter supply than others. So, I do think there are some supply chain issues which I expect to get better. People are very excited about Trainium2, to your question on whether we could see more demand there. And we have gone back at least a couple occasions to make more Trainium2 than we'd intended because we have so much demand. So I expect that we'll have customers for as long as I can foresee wanting to run compute on instances that have NVIDIA chips, but I think a lot of the demand will also be served by Trainium.
Sam Altman echoes this in a recent post on X, indicating that OpenAI has also been experiencing chip supply constraints. Elon Musk has also been constrained for chips, having reallocated $500 million worth of Nvidia chips from Tesla to X in the last 12 months. There is also an indication that Elon needs significantly more chips than he currently has, having announced plans to expand xAI's Colossus AI supercomputer from 100,000 GPUs today to 1 million GPUs in the future. That's 10 times the current spend on chips. Broadcom is also predicting that 3 of its clients among the hyperscalers will deploy AI supercomputers with 1 million chips by 2027. Now, to what extent this will happen and by when, we'll have to wait and see, but it does further support a continued demand for chips. We're also seeing AI services being adopted across a wide range of sectors, from finance and advertising to healthcare, automotive, robotics, and beyond. This broad uptake is further driving a sustained need for high-performance chips, and from what I'm seeing, I expect the demand for these services will continue to grow. Now, there was the announcement from DeepSeek that happened back in January, where they released an open source model and claimed that they were able to train and run their model for a fraction of the cost of the large US companies like Google and OpenAI. And this has created some uncertainty around whether the demand for Nvidia's chips would be sustainable. The argument behind this is that if AI service providers can achieve more efficient models, then they won't need to buy as many chips from Nvidia and will scale back demand. Now, the claims have been disputed, so there is some uncertainty around the potential impact on the demand for Nvidia's chips. However, there are 2 things I find quite interesting. The first thing is that we're not seeing any indication from big tech CEOs of a pullback in spending on chips. Going back to the recent interview with Andy Jassy as an example, they still have a high demand for chips. And the second thing, which I think is even more interesting, is a point that Jensen Huang brings up in his interviews around the reasoning model introduced by DeepSeek, indicating that unlike conventional models, this new model requires significantly more compute because they generate multiple answers and then select the best answer, potentially demanding 100 times more compute. And with more compute comes the need for more chips.
There are reports that China's DeepSeek is pushing up the launch of R2, its successor to January's really popular R1 chatbot, from May to basically as soon as possible. Do you know if the upcoming DeepSeek model uses NVIDIA chips, which ones, and how concerned are you that cheaper ways to train models might mean fewer sales of your pricier Blackwell chip, which is obviously very popular right now?
DeepSeek is fantastic. And in fact, what DeepSeek has done is it open sourced a new type of state-of-the-art AI model called reasoning models. Reasoning models are basically models that think. Instead of you asking the chatbot a question and it instantly spews out an answer, and it does a really good job doing it, but now the chatbot will break the question down step by step, reason about it. It might produce several different versions of it internally in its head, choose the best answer before it presents it to you. And so it turns out that these reasoning AI models has discovered a new scaling law, and a scaling law says the more compute you apply to thinking, the smarter the answer. And so it's exactly the opposite. What DeepSeek has done is actually opened up a whole new field that consumes an enormous amount of NVIDIA's computing capability. Just about every AI developer has now incorporated either R1 or technologies like R1, chain of thought and reinforcement learning and search and so on, to improve the quality of their answers. And so what really happened is that this new generation of AI models has caused demand to be really high.
Looking ahead, even though processing costs may decrease as models and NVIDIA chips become more efficient, there will continue to be a trade-off between achieving efficiency and having models that can handle increased complexity and produce better results. Industry leaders like Satya Nadella argue that lower costs for AI services will drive even greater adoption and, in turn, boost demand for more powerful chips. Another factor impacting the demand for chips is the replacement of existing data center GPUs. According to a high-ranking specialist at Google, the company has needed to replace high-usage chips every 1 to 3 years. This replacement of GPUs creates recurring demand for GPUs longer term, which is a good thing for Nvidia. Nvidia has had significant sales for data center chips over the last 2 years. If we see customers replacing chips at the rate indicated by this Google specialist, we should see some of this replacement demand hitting revenue in 2026, 2027, and beyond. Now, finally, whenever a company has a large market share and is demonstrating exceptional returns, there will generally be those that want to compete for that market share. Nvidia currently has over 90% of the overall data center GPU market, so significantly dominates that market. Now, why I think it will be hard for the companies to take market share from Nvidia is that Nvidia has such a large head start on the competition and has a majority of the customer base, which means that they are getting more feedback than their competitors, which allows them to improve their products faster than their competitors. Moreover, Nvidia has built an entire ecosystem around its technology, offering not just GPUs, but a suite of complementary components and software that integrate into AI data centers. This deep interconnection creates significant switching costs for its customers, effectively locking them into Nvidia's ecosystem. So I don't see any of their competition taking a significant portion of their market share in the next 2 or 3 years. Now, to summarize this entire analysis, Nvidia's fundamentals have kept pace with its rising stock price, and price ratios have remained at reasonable levels compared to their historic rates, though at a slight premium relative to the market and some of their peers, indicating that, at least in the short term, Nvidia does not appear to be in a bubble. Nvidia's rapid growth in recent years has been fueled by soaring demand for its AI chips, like the H100, within data centers. The company's valuation ultimately hinges on its ability to sustain and grow the sales of these chips. Indications from major tech companies suggest that in the near term, demand for AI chips will continue to outpace supply, with an indication that CEOs of major tech companies may collectively increase their spend on data centers by around 30% in the next 12 months. Some of the demand is expected to persist longer term, with increasing demand for AI across a wide range of sectors, and with existing chips needing to be replaced during upgrade cycles. Based on all this, I expect chip demand will keep rising, and I believe Nvidia has room for growth over the next few years, though at a slower pace than the impressive performance we've seen over the past 2 years. As we look further ahead, demand becomes less certain if models and chips become more efficient or if the lifespan of chips increases, so this is something we'll have to keep reassessing. With all the demand for chips, I think there will be other companies in the chip space, like ASML and TSMC, that are positioned well to capture value across the supply chain. With the share prices of these companies dropping 20% or more from their all-time highs, I'm considering entering a position in 1 or 2 of these companies, and will be considering their fundamentals, valuations, and growth prospects further before I enter a position. I'd love to hear what you think. Drop a comment below and let me know what your thoughts are on Nvidia and some of the companies in the semiconductor space like ASML and TSMC, and whether you're investing in any of these companies. If you found this video helpful, hit that like button and subscribe for more stock investing news and insights. That's it for this video. I'll see you in the next one.